Good afternoon, everyone, and welcome to the latest in our series of professional advisors working lunches, today brought to you courtesy of our partner, Baillie Gifford. I'm Hope Williams-Smith, the editor of Professional Advisor, and I will be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could please keep them that way. That will just ensure there's no background noise and that our speakers can be heard more clearly. I should also inform you that this session is being recorded and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual today, our working lunch will qualify for 1 hour of CPD and we'll be sending you proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. Now, Warren Buffett once said, know your circle of competence and stick within it. The size of the circle is not very important. Knowing its boundaries, however, is vital. This could be considered a useful frame of reference when thinking about any house's investment philosophy against the current backdrop of market volatility and heightened uncertainty. So, with that backdrop in mind, I'm delighted to be joined today by Baillie Gifford's Claire Shaw, who is an investment specialist with the Baillie Gifford Scottish Mortgage Fund. Over the next hour, I'll be talking to Claire about the role Scottish Mortgage can play in investing in the future by embracing change, by embracing the possibilities, and embracing progress. Do feel free to put all and any of your questions to Claire using the chat function, which you'll find at the bottom of the screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, and that way only I will be able to see it. Now, just before I hand over to Claire, let me quickly run you through our learning objectives for today. So by the end of the session, you will be able to understand the unique philosophy that sits at the heart of Scottish Mortgage, understand why long-term structural changes in society are more powerful drivers of change and disruption than macroeconomic or geopolitical issues, and why it is rational to seek out the exceptional companies driving this change in order to maximise your chances for growth over decades. And finally, to understand why the current environment still leaves room for optimism for the investor willing to take a long-term patient view. So that's everything covered, CPD covered. And now let's hear from Baillie Gifford's Claire Shaw. Good afternoon, Claire.
Hi, Hope. How are you?
Well, thank you.
Super. I am just going to share my screen, hopefully, if you can confirm that that is hopefully working now at everybody's end. So firstly, thank you very much for taking the time today to come and listen about the Scottish Mortgage Investment Trust. As Hope alluded to, I'm going to start the presentation in a slightly unusual place. And by unusual, I mean, it may seem somewhat strange that a growth investor is putting up a quote from probably the world's most well-known value investor, but it provides a useful frame of reference for where we find ourselves today. You know, this has been a tough year so far for Scottish Mortgage shareholders. In fact, it's probably been one of the toughest in recent decades. And, you know, we need to be upfront and acknowledging that even for, you know, long-standing shareholders, this has probably been neither a pleasant nor comfortable time. And it's been a difficult year in the respect that we're in this period of heightened uncertainty. You know, the noise in financial markets has been deafening this year as the market's really trying to process a multitude of factors, whether it's inflationary concerns, interest rate rises, the war in Ukraine, supply chain issues, geopolitical tensions between China and the US, you know, to name a few. So from our side, it's evident that the short-term outlook is unclear. But we don't believe there's any value in us making macro predictions. You know, this is not where our core skill set lies. And so when thinking about a topic for today's presentation, you know, I kept on coming back to this Buffett quote on your circle of competence. You know your circle of competence and stick within it. And so against the backdrop of a challenging period of performance, we need to retain our humility and remind ourselves about, what is our circle of competence? What is it we know and we can control? And how does this translate into giving us an edge? What is Scottish Mortgage's circle of competence that can hopefully make shareholders, those good long-term returns? So in terms of, what is it we know? Coming back to starting with that point, from our side, what we know is that only a small number of companies really matter. And so what do I mean by that? So there's some stats on the screen there, which shows that over the last 20 years for Scottish Mortgage, we've owned 749 companies. 398 of them have made a positive contribution. 282 companies have destroyed value. But when you break that down further, what's really interesting is that basically 91% of companies, or 680 of those companies, didn't really matter. But by contrast, 69 companies, which is 9%, drove all excess returns. And that's even more incredible when you break it down further, which is only 14 companies accounted for half of that wealth creation. Now, at first glance, this may seem shocking, but the same story is true for indices all around the globe as well. If you take the US equity market, for the last 90 years, to 2019, that 9% for Scottish Mortgage is even more concentrated. It's actually 4%. 4% of all value created in US equity markets was driven by that handful of companies. So what does that mean in practice? In practice, it means our focus is on trying to identify that kind of small handful of companies that can drive that transformational change across the world over the next years and decades. We want to identify robust companies with visionary leadership. Can we find those companies who can scale and run by people we trust? And I think it's interesting because this kind of thinking is not really taught in conventional financial education. I use the phrase with clients quite a lot. We're optimists, not pessimists. The dominant investor mentality is about limiting volatility and avoiding downside risk. We focus on the upside because you need that blue sky thinking to go after those extreme returns. And why is that? And it's because the reality is, if you can find just one or two of those golden needles in the equity market haystack, then they will more than compensate for losses elsewhere. So for Scottish Mortgage over the last decade or so, the returns of our biggest winners, Tesla, Amazon, Tencent, to name a few, have more than compensated for the biggest detractors elsewhere. So coming back to that circle of competence, what is it we know? We know that equity investing is about finding the few exceptional companies that can generate those outsized returns and then hold them for long enough so that returns accrues to our shareholders. So what else do we know? We know that volatility is inevitable. Volatility is not unusual. And so in our quest to find these few exceptional companies, for us, we're very comfortable with this notion that progress is rarely a straight line. Extreme returns and smooth performance are mutually exclusive. So when we're talking about change and disruption, the one thing we can guarantee is that path's not going to be a smooth one. And the companies that are often the biggest outliers are often the most volatile. And this is because those transformational outlier returns are not going to materialize overnight. So you need that long-term time horizon and patience to tap into them and allow these investment cases to come through. And so for Scottish Mortgage, as you can see on the chart, the strongest long-term absolute performers have tended to be amongst the most volatile. So to pick out a couple of examples, you can see Tesla there's had 10 drawdowns over 10%, the biggest one being just under 50%, but we've made over 40 times our initial investment. Similarly, Amazon, has had 8 drawdowns over 10%, the biggest being over 50%, but we've made over 11 times our initial investment. And you can look at Scottish Mortgage as an investment trust through a similar lens. Ironically, it's no different. Since the trust was founded in 1909, it's had 10 periods of drawdowns over 20%. But if you look in the last 10 years, we've made over 500% for our shareholders. So what that means in practice is that, our role during the kind of erratic market periods that we're witnessing at the moment is really to quietly support our companies. you know, I say here on the slides that we are resolutely long-term through the good times and the bad, because, you know, we invest for the long term. You know, it can take years for the characteristics of these exceptional growth companies to be fully reflected in our share prices. So what we do know is that our edge is our time horizon. You know, on a 5-year view, we can still see growing opportunities to own underappreciated growth businesses. So, you know, are we panicking? No. You know, have we been through volatile periods with our companies before? You know, yes. And what we do know is that patience is probably most important when it feels most difficult to exercise. And then I've used this phrase a couple of times about, you know, we're looking to own the most exceptional growth companies. So how do we define this? You know, for us, the power of truly great businesses are ones who reinterpret the industries in which they operate. So what we know is that change drives growth. You know, our focus is very much on what the world looks like in 2030 and beyond. And so we think having that imagination is as important as crunching the numbers. You know, you need to imagine what if, you know, rather than what is today. So, you know, the future of transport, what might this look like? You know, we might land at Heathrow Airport and get a Lilium flying taxi to take us to Canary Wharf. You know, instead of a postman delivering your Amazon box, a zipline drone might drop it off at your front door. You know, take finance. What might the future of finance look like? Very controversial idea, but we might be using cryptocurrency instead of conventional money as we know it today. You know, the future of healthcare. If you get a cancer diagnosis, it's highly likely that your treatment will be personalized according to your genetic makeup. Future of food, you know, instead of getting your meat from an animal, it might be grown in a lab. Upside Foods, one of our holdings, is at the forefront of the cultivated meat industry, which is growing meat directly from animal cells. This is real meat without the animal, you know, meat without the slaughter, if you want to think about it like that. You know, and then energy. What might the future of energy look like? You know, well, what if you could decarbonize the chemicals industry? One of the dirtiest in the world. You know, what if you could make clean chemicals? You know, Solugen are changing the way chemicals are made, one that's using bio-based inputs instead of fossil fuels. And so why is this important? And I think it's because this imagination, you know, can't be taught. You know, anyone can learn how to run a discounted cash flow spreadsheet in Excel, but, you know, for Scottish Mortgage, you know, we're not investing in the status quo. You know, we're investing in the future. We're investing in new ways of doing things, not the old ways. And I think investing in the old ways, you know, the way we do things today, it might feel safe and reassuring, but it can be anything but that. And I think for us, investing in the future is about embracing change, embracing the possibility, and really embracing progress. So that's a lot on, you know, what we do know. But coming back to our circle of competence, I think it's also important to highlight what we don't know and crucially accept what we don't know. And so right now the market is trying to process a lot. You know, as I said at the beginning, it's trying to work out the impacts of a global pandemic, the war in Ukraine, geopolitical tensions, you know, inflation, interest rate rises. And as a result, market time horizons have shrunk, uncertainty has taken over, and stock prices are moving as one, mainly in a downward trajectory. And in these conditions, we need to retain our humility about our ability to predict these near-term events. And I think what we need to be very clear is that we are not geopolitical experts, nor are we macroeconomists. You know, we have little visibility about whether inflation will be higher, the higher inflation will be prolonged. We don't know what interest rates, GDP will be this year or next. But here's a crucial point. You know, even if we did know that, even if we did have that crystal ball, we're not convinced it would actually help us make better long-term investment decisions. And I think it's at this point, it's kind of helpful to come back full circle and come back to the first principles. You know, what's the purpose of Scottish Mortgage? The purpose of Scottish Mortgage is to identify and own the world's most exceptional growth companies. And the reality is that the success of these companies really will have very little to do with interest rate cycles, for example. So to give you some context around that, you know, do we really think the Fed raising interest rates would have stopped the rise in success of Tesla or Amazon over the past decade? You know, I don't think so. You know, for us, these exceptional growth companies that address large market opportunities and their ability to capture those opportunities as opposed to economic cycles that will be the primary determinant of long-term outcomes. So on that basis, we feel that kind of the factors that are driving the portfolio, you know, do seem unlikely to be knocked off course by any macro headwinds. And then maybe just as a sort of last sort of slide, I thought it'd be interesting, given where we are in this climate, to measure our contentions against recent events. You know, is it worth revisiting whether they're still intact in this weaker environment? So we've held the view for a number of years that very broadly speaking, there's likely to be 3 big drivers that's going to dominate the portfolio over the next decade. This is energy transition, the intersection of healthcare and technology, and the continuing digitalization of the economy. But in any period of challenging performance, it's important to ask yourself, you know, what if you're wrong? What if we're wrong in this? And for us, we think the best way of challenging yourself is to invert your thinking. So ask yourself the opposite of your contention. So, you know, to go through those, you know, taking the energy transition to start with, you know, we believe we're moving away from a world of carbon-based energy generation and transport towards electrification and renewables. And you can see in the portfolio today how many of our holdings are exposed to that theme. But ask yourself the opposite, you know, do we really think we're going to be using more fossil fuels or buying more diesel engine cars in 10 years' time? You know, we don't think so, no. You know, coming to healthcare, you know, we think the healthcare sector will continue to be more personalized, driven by genomics. You know, we think insights into diseases will become faster and cheaper, driven by machine learning and artificial intelligence. You know, ask yourself the inverse. You know, what the pandemic has shown us is that genomics has sort of gone from this peripheral tool to a central one in public health policy. Can we really see that reversing? You know, no, we don't think so. You know, and finally, the sort of the digital transformation that kind of has revolutionized the retail, the media, and the advertising worlds over the last decade is now broadening out into fields such as food and finance and enterprise. But again, ask yourself the opposite. Do we really think that the move to more commerce online is going to reverse? You know, do we really think we're going to be shopping more in bricks and mortar stores than utilizing the convenience of online shopping? No. Are we going to consume media in a linear fashion again, as opposed to the benefits of on demand? No. You know, our enterprise is going to go back to on-premise solutions versus utilizing the benefits of cloud infrastructure. You know, we think it's unlikely. So when you bring all this together, you know, have the contentions that we hold come into question in the weaker environment that we find ourselves in today? And the answer we think is no, because the structural shifts that underpin our holdings will continue whether we're in a recession or not, whether interest rates rise or fall. And this is because the great companies will still make progress in difficult environments. You know, we own companies on the right side of these structural shifts. You know, companies that are pushing progress in their industries through really purposeful and committed investment in growth. Now, what I should say is this doesn't mean our holdings are going to be immune from the environment that they operate in today. You know, some naturally will produce lower rates of growth than our investment thesis calls for, and that's okay, as long as we still see that long-term, you know, opportunity. So coming back to that kind of first principles point, you know, and what is the purpose of Scottish Mortgage? You know, to be open to those possibilities, to be open to change and the people driving them, you know, for us to invest in them and essentially, you know, to help play a small role in facilitating that change. So that was a sort of 15-minute sort of quick overview. I think there's a lot of questions that's been coming in, so I can, making sure there's plenty of time to get through all the questions that's been submitted and ones that are on screen.
Yeah, there are definitely quite a few. Thanks so much, Claire, and thank you for your introduction. We are going to head into some Q&A now, so please, we've been saying, do drop in your questions and I will get around to asking them. But just before I dive in, Claire, I did want to start with one of my own. I wanted to ask you about China. Exposure to China continues to be a divisive topic among advisors.
Yes.
So please, could you tell us a little bit more about your exposure?
Yeah, no, naturally, and obviously very, very topical right now. I think the first thing maybe to say, Hope, is that we're still kind of digesting a lot of the news that has come out of events of last week and the subsequent market reaction. Our kind of initial thoughts is it's probably incrementally negative, primarily around the kind of absence of supportive comments around, private businesses was notable. But what I can say is that when you look at China, per se, it's not a one-dimensional situation. This is not a one size, fits all. And so for us, we kind of look at it through a couple of different lenses. We have been trimming some of our positions, companies such as Alibaba and Tencent. We have been making some trims to those positions. But on the other side, there's still areas where we do see interesting opportunities, and that those are the ones that are probably more in line with government's objectives. So, companies that are exposed to, electrification and renewable energy, artificial intelligence and technology. We still see interesting opportunities there. But I would say on the whole, Hope, over the course of the year, we have been reducing our exposure to China.
Thank you for that, Claire. Now, one delegate has said, given poor performance this year, what changes, if any, are you making to your investment strategy?
So obviously, poor performance is on a short-term basis. So as I mentioned during the presentation, over the last 5 years, we've made over 500% for our shareholders. We've outperformed our benchmark significantly. So on that basis, we say to investors that it's, for Scottish Mortgage, you kind of have to have that long-term time horizon. We say to our shareholders that this is a 5-year view, and so yes, recent performance has been challenging, but there's been no changes to the strategy or the philosophy. What I said at the beginning, what is our purpose? What is it we're trying to do? We are trying to own the most exceptional growth businesses in the world. There's been absolutely no change to that. There's been no change to the way we analyze companies. There's been no change to the lens in which we view our companies through. So yeah, as I say, in terms of the performance, it depends on the lens in which you look at it through. Yes, over that shorter term, performance has been challenging, and we can't shy away from that. But as I say, given the nature of our investment style, we do think it's better to look at our performance through that 5-year view.
Thanks, Claire. We've got another sort of similar question here that ties in on that. Someone said, isn't your fund's goal to produce a positive return in the 5 years rather than looking at these sort of far in the future winners?
Sorry, could you repeat the question, Hope? Sorry, I just maybe misunderstood what you...
So they were saying, isn't the goal of your fund to produce a positive return in 5 years rather than focusing on winners far in the future?
I think our investment strategy is obviously to provide good long-term returns for shareholders. But as I say, in terms of what we're looking at in terms of performance numbers, as I say, over a 3-year and over a 5-year view, performance does still remain. I'm just pulling up the numbers now. Performance does still remain, very, very strong over that kind of 5 and 10-year viewpoint. So, as I say, yes, there is always going to be periods of underperformance, and I kind of alluded to that hopefully in introductory comments, where we know that volatility is inevitable. We know there's going to be periods where we're out of favor, and that's okay, as long as we tend to see that as long as that long-term opportunity still remains for our holdings, we remain comfortable. And if you look at if you look at the growth rates of our portfolio, the underlying holdings in the portfolio, they're still incredibly robust. Over 30% of our portfolio is growing at, over 50% top line growth. And that's despite, a very weak backdrop. So if you look at the operational performance of our companies, they're still, delivering phenomenally good results from that operational standpoint. But there's that disconnect with the share price. The share prices have been hit hard as growth is out of favor. But in terms of are we, is there cause for concern in the operational progress of our holdings? Take the top 30 companies, which is about 75% of the portfolio. There's very little cause for concern in the underlying progress of these companies, and that's and that's really what we're focused on.
We've got a sort of a comment and a question here from one of our listeners that says, we have the highest inflation we've seen since the 1980s. So as growth investors, why should investors trust you with value investing or investing in this inflationary period?
Yeah, so it's the growth versus value lens is an interesting one, and from our side, we don't actually think it's a helpful lens to view things, growth versus value, and the reason is very simple. All growth is not equal, and all value is not equal. So with growth stocks, some have debt, some don't. Some have strong competitive advantages and thus pricing power, which helps in an inflationary environment. Some don't. Some are early stage and well funded. Some have a clear path to profitability, some don't. So I think the first thing to say that, viewing the market through this lens of growth and value, we don't actually find that helpful. What I would say in terms of the inflationary period is that obviously a lot of the companies that we're looking at, and that we hold today, do have that strong competitive advantage. They are able to pass on price increases to their customers. Take Tesla, for example. Tesla is not a company that is demand constrained. Any of Tesla's, short-term issues are around supply chain bottlenecks, whether that's on logistics, whether it's on chips. And they've been very honest about, they're having to put through price increases to deal with raw material hikes or whatever it may be. But again, coming back to this point on looking at the operational performance of these companies, Tesla delivered, record deliveries in the last quarter. They're making record operating margins. I think the last results were they're making, just under 18% profit margins. This is kind of very unusual in the automotive space. So, what we're looking at and what we're analyzing for our companies is, how strong is the pricing power that they have? Can they pass those on to customers if that's the case? Some companies may not be able to in the same way, and those are the companies that we're looking at. We may be trimming them on that basis. But as I say, and what I came back to saying in the presentation, hopefully, is that the companies that we're investing in are exposed to deep structural shifts, whether that's in the enterprise market, the energy market, the healthcare market. And really, inflation is not going to be the primary determinant of their success or not. Is the scale of the opportunity that exists over the kind of 5 to 10 year view.
Great, thank you for that. So a few people are commenting on losses within the fund. Some people are saying 40%, some people are saying 45%. So to start with, please could you sort of clarify for our listeners and then also give us your view on a recovery period?
Yeah, well, in terms of a recovery period, I mean, it's impossible to put a timeline on when when we'll recover. I mean, as I say, we don't have a crystal ball, and we can't tell you when things will recover. But what we can say is that, as I say, over our investment horizon, we are still confident in our holdings. And as I say, coming back to this concept of this disconnect right now you see between share prices and the operational performance of companies, it's staggering. And so what we have to do is almost ignore the noise in the markets and focus on those fundamentals. You know, as difficult it is to do, you know, what we cannot do in periods of tough performance is be blown off course. You know, I think the worst thing investors can sometimes do is change your philosophy based on a short-term challenging period of performance. You know, it's a harder thing to do, to actually sometimes stick with your beliefs, which is what we are doing. And as I say, if there was concerns around the underlying fundamentals of these companies, then that's a different set of that's a different scenario. But as I say, when we look through the top 30 companies, as I say, which is about 75% of the portfolio, you know, we do remain comfortable and very optimistic, I should say, because actually it is the case that these companies are still growing phenomenally well. It's just that the market is punishing companies right now that are either loss making, or, you know, their cash flows are so far out in the future. So in terms of the Scottish Mortgage portfolio, the companies that have probably been hit the hardest are those sort of long duration growth stocks. So the companies, you know, that right now are not generating revenue, they're not generating profit. Those are the companies from a sentiment perspective that are being hit the hardest. But actually, if you look at the sort of how much of the portfolio is loss making, if you like, you know, that's got negative earnings, negative cash flow, you know, it's just over 10% of the portfolio. You know, over 50% of the portfolio is generating positive earnings, positive cash flow. Obviously, then we've got the private companies, which account for another 30%. But as I say, when you look at the companies that, you know, maybe there maybe are some challenges ahead with access to capital, you know, those are the companies that we're focused on and analysing in a lot of scrutiny. But as I say, overall, you know, the robustness of the portfolio and the companies is strong at the moment.
Perfect. Thank you for giving us some detail there. I'm going to pivot to a slightly softer question, which is asking you how involved your team have been in advising the companies that are struggling with the macroeconomic situation, in particular very new companies, and have you been more connected with their management teams?
Yeah, that's a very very good question, and the reason I say that is that I think one of our edges, which maybe we don't talk about as much as we maybe should, is the access that we have. You know, we have a reputation as very long-term and very patient shareholders. You know, we see ourselves very much as partners to companies, not, you know, we're not renting shares. And what that means in practice is that we get access to the founders and entrepreneurs, and we're able to have, as a result of that kind of reputation that we have, we're able to have those more robust conversations with companies because there's that honesty there, because, you know, we are seen as partners to these companies. We're able to have some of those more challenging questions, and we're able to understand, you know, what concerns that they have. So absolutely, you know, a lot of the we've had some really interesting conversations with some of our companies, especially the ones that are almost using this environment to consolidate their competitive advantage. So, you know, let's take, for example, like the food delivery space is probably a good one maybe to use. You know, the food delivery market is incredibly competitive, and there's been a lot of access to cheap capital over the last, you know, 5 to 10 years. But we own companies such as Delivery Hero, which is the largest food delivery network in the world outside of China. And what their founder, Nicholas Osberg, has been saying to us is that actually they're continuing to invest, you know, despite this challenging backdrop, you know, sort of like in the face of adversity, they're continuing to invest in growth because they actually think that, you know, their competitors are going to get weaker as they struggle with piles of debt and the subsequent interest payments that comes with that. They're actually able to capitalize on that and invest more and take more market share. So I think I asked one of the questions earlier was around this growth versus value, and it comes back to not all growth companies are the same. You know, a lot of our companies, you know, have a robust balance sheet, so they're able to almost like capitalize on this weaker environment, and they will come out the other side stronger. So a lot of our sort of conversations with our companies right now is to provide that support, to almost encourage them that actually to keep focused on that long-term vision, that continuing to invest in these challenging periods will pay dividends over the long term. So yes, we speak to all of our management teams. We're incredibly fortunate to have very, very healthy relationships with a lot of our companies. About 80% of our companies are founder led, which again helps with that kind of partnership mentality. So as I say, our role is maybe not advisors as such. I think it's there to provide that support and almost like the sort of the confidence to sort of stay on that long-term vision that the companies have.
Thanks so much, Claire. Sticking sort of with a similar theme here, thinking about the environment at the moment, I think a lot of people have a question in the current economy whether there is even a case still for growth stocks. So I'd be interested to hear your take on that, given everything that's going on in the markets and with the environment at the moment.
Yeah, I mean, as I say, I think it comes back to the measuring, our contentions against recent events, maybe taking the energy sector as one example. I mean, parts of the market may look cheap, optically on a PE basis, whether that's the oil majors, for example, but is that the company you want to be owning over the next 10 years, or is it a Tesla, or is it a Northvolt, which is a company who are basically producing all the batteries for electric vehicles in Europe? The potential growth of something like a Northvolt, massively excites us. So for us, when you're thinking about the growth versus value lens, yes, value may look optically cheap based on current multiples, but we're looking at future earnings. Where are the growth rates? Where's the growth going to be happening in the future? And so companies that are exposed to electrification, whether that's electric cars, whether it's the supply chain around that electrification, whether it's companies that are developing new climate technologies. So I mentioned Solugen, who are trying to decarbonize the chemicals industry. We've also got another company called Climeworks, and what Climeworks are essentially doing is direct air carbon capture. So they are capturing ambient air out of the sky and storing it underground as a way of sort of negative emissions, if you like. So we think all these companies are the future. We think that is where shareholders are going to make that longer term. The best returns are going to come from these sectors, as opposed to as I say, the more traditional sectors, such as whether it's traditional oil and gas companies, whether it's traditional retail or whatever it may be. They may look optically cheap, but a lot of the time they're cheap for a reason. So on that basis, as I say, we still remain very committed to the areas, the themes that we still held, a year and a half, 2 years ago, when we were in a different climate.
Excellent. Well, we've got a couple of broader thematic questions here. So one to start off with, Claire, would you consider Japan a future opportunity alongside China for a growth fund? Yeah,
it's a good question. So our remit is, we have an incredibly broad opportunity set. So out of all the Baillie Gifford strategies, we probably have the broadest opportunity set. And what I mean by that is we have a global remit, but we also have the ability to invest in private companies as well as public companies. And so with that global reach, yes, obviously we do have China. It's about 15% of the portfolio at the moment. We don't have anything in Japan. I mean, that's never to say never, but in terms of the sorts of characteristics of companies that we're looking for, we haven't actually found any companies that fit those that fit that bill. Where we have probably been adding to a little bit more exposure over the last couple of years would be in Latin America. So you'll see in the portfolio today, Mercado Libre is now one of our larger holdings in the portfolio. We also added a delivery company called Rappi, which is a private company which spans across Latin America as well. So in terms of the sort of geographic distribution, I would say that there's probably incrementally a little bit more in Latin America, probably a little bit more in Europe actually as well. We think there's been a number of really interesting companies developed over the last few years, and particularly around that sort of energy theme. So I mentioned Northvolt already in Sweden. Climeworks is Swiss-based, to name another one. So I think it would be probably more incrementally Europe and Latin America as the sort of the main geographic changes that's been implemented in the trust.
Well, keeping on the international theme, one of our delegates has asked, how do you view the breakdown of globalization as a challenge to the companies that you are investing in?
Yeah, so it's probably something that's taken up a little bit more of our time, just even thinking about it, recently. And I think sort of areas where it's particularly pertinent is probably around the semiconductor space and really, our thoughts around, we own ASML in Holland, which is obviously one of the world's leading suppliers of lithography machines to the chip makers. And so right now with geopolitical tensions, there's a lot of focus on that supply chain. Obviously the position of TSMC in Taiwan and that almost silicon shield that it's providing at the moment is definitely something that we are monitoring quite closely. As I say, ASML and NVIDIA is probably the other one to mention, which recently Washington recently put out a note to say they'll be banned from selling certain high-end AI chips into China. So all these developments we are monitoring very, very closely, and what that means and the implications for our companies. But as I say, from our perspective, there's probably the most attention, the area where it sort of is of most interest and of focus for us right now is probably around that kind of semiconductor chip space. And for us, the ASML and NVIDIA are the ones we're probably watching carefully from that globalization perspective.
Great, thank you. I just want to remind all of our listeners, we've got just over 10 minutes left for questions. So if you've got anything burning that you want to ask Claire, now is the time to get those questions in. Claire, moving things a little bit closer to home, somebody has asked, do you see value in UK equities? And if so, are there any specific companies that you're taking note of at the moment?
Yeah, so I think, again, it sort of comes back to what it is we're looking for. I kind of maybe alluded to it a couple of times. We're looking for those, visionary entrepreneurs that are going to create businesses that can scale and be, real global players. And I think the UK has traditionally not been very good, not been a very good breeding ground, if you like, for that sort of entrepreneur. I think, there are a couple of examples for us in the portfolio where we do, we are pretty excited from a UK perspective. So something like Ocado, for example, the online food delivery company, we really see the opportunity for Ocado is very large and global. I think penetration is still very, very low in this, and we think that, as I say, over the long term, someone like Ocado, could be a very, very, very sort of interesting business over that kind of longer term period as we kind of have the structural shifts to online groceries. We're still very early in that cycle. So for us, Ocado would be one. Wise maybe would be another one to mention. In the UK, it was previously TransferWise. I think that would be an interesting one to mention as well. What they're obviously involved in is the transfer of international money. They're trying to tackle the problem of high fees and low transparency. So Wise is one that I think that we think that's got a really interesting competitive advantage. I think now it's almost at a point where it'd be very difficult to replicate the pools of liquidity that Wise have in various markets. And so I think companies like Wise in the UK and Ocado, we're very, very excited about over that kind of 5-year basis.
Excellent. So I wanted to ask you, sort of looking back at the fund, a little bit more of a technical question. What are the limits on private company and threshold levels?
Yeah, so the limits on private companies are, it currently sits at 30%. Today, the percentage that we have in private companies is just over that 30%. And what this means in practice is, if it ticks over the 30%, it doesn't mean we become forced sellers. What it means is that we cannot buy any new private companies, or we cannot participate in any follow-on funding rounds. And there's a couple of factors really as to why that number is high. I mean, it's the highest it's been in the history we've been investing in private companies over the last 10 years. But if you think about the sort of mechanics of the market and what drives that number, one of the factors that drives that 30% is not only the number of new companies that we're buying that are private. So just to give some context around that, it's about 2/3 of our new buys over the last couple of years have been private companies. What's normally the offsetting factor is the number of companies that are choosing to go public. Now, if you cast yourselves back a year ago, we had, I think, 11 companies in the portfolio IPO during 2021. This has been 0 so far in 2022. Because obviously market conditions have, entrepreneurs and the founders of these companies just haven't, thought it's the right environment to be going public in. And so what that means by proxy is that the number that we have in privates today is quite high, because almost that offsetting factor that brings that number naturally down, the tap has been turned off, so to speak, on that basis. So as I say, the limit we have is 30%. We bought 2 new private companies this year. I think I've mentioned both already, Climeworks and Upside Foods. But as it stands at the moment, we are kind of at our limit, so to speak, which is absolutely fine from our perspective. We've seen other opportunities in the public market space that we've added to, such as Roblox and Cloudflare recently. But the key thing to note is that, as I say, we don't become forced sellers above that 30% mark. But as a lot of the reasons behind this are just to do with the mechanics of the market, that we're not really having any companies that are choosing to go public, which is keeping that number kind of quite elevated at the moment.
Great, thank you for that. We've got a sort of quite long comment and question here. So asking, SMT and BG are quote unquote active fund managers. Oil giants like BP and Royal Dutch Shell have had a strong last 2.5 years. They say an active manager could have reaped profits here and then offloaded these. So do you feel that you have perhaps held on to poor performing assets and missed some of the opportunities that the last 12 months or so offered?
Yeah, and I absolutely appreciate that some of these companies that are mentioned, BP, Royal Dutch have had a great couple of years, and you have that dividend yield. I think what I would say is, Scottish Mortgage doesn't claim to be, we don't claim to be a full part of everyone's portfolio. What we are trying to do is quite unique. And I would say it's very difficult to replicate what we do elsewhere. There are plenty of other fund managers that, would be happy to buy those companies on a 2.5-year view, make a profit and sell out. But it come back to what I said about our philosophy. We see ourselves as partners to companies. We see ourselves as being owners of these businesses. A lot of our investments is primary capital, into these companies. And so we don't really think about it as kind of buying and renting shares and then making a quick profit and moving on to the next thing. That's not our philosophy. And absolutely, you can get that elsewhere. But I think we need to be really clear in what it is that we're doing, and what it is we offer is, we're offering access to the best growth companies in the world. And when you think about 30% of the portfolio being in private companies, it's very, very difficult for people to get access to these companies. It's very difficult for the average person to get access to SpaceX or to Northvolt or to Stripe or ByteDance, the parent company of TikTok. All of the value that's being created in these companies, you know, away from the public markets is very, very difficult to get that elsewhere. And so I think Scottish Mortgage has a unique role to play in people's overall portfolio or asset allocation decisions, because we do have quite a unique portfolio from that perspective. You know, we don't claim, as I say, to look like the benchmark or be anything like the benchmark. You know, we're trying to only identify the companies we think can make between 5 and 10 times our initial investment. You know, we're looking for companies that have that unique quality of, you know, visionary founder, ability to scale, huge market opportunity. And, you know, at this moment in time, you know, companies like BP and Royal Dutch Shell, you know, for us, we probably find more interesting opportunities, you know, with companies such as Northvolt or Redwood Materials, which is a US company involved in battery recycling. Those are the areas that we think have got more of a chance to generate those 5 and 10-fold returns for our shareholders. So hopefully that's answered the question.
I think that is a good answer there. So just one last question here. How do you manage downside risk when there is a move from growth to value?
It's a difficult one to answer because, as I say, it's not the lens in which we look through our companies. You know, we see risk as, you know, a permanent loss of capital. But and this is going to sound quite a strange thing I'm about to say, but on one of those early slides, I mentioned that, you know, 9% of all of our returns over the last 20 years, you know, all the returns were generated by 9% of our companies. What that means is 91% of companies don't really matter. And so we're incredibly comfortable with the notion that a lot of our companies, you know, we are going to lose money on. But if you think about that intuitively, you know, if you invest in a company, the maximum you can lose is what you initially invested. But the maximum you can gain is unlimited. And that comes back to that kind of blue sky thinking. It comes back to that, you know, if this company gets it right, you know, you can make those huge multiples of your initial investment. You know, I mentioned Tesla, I mentioned Amazon, you know, ASML, NVIDIA, whatever company, you know, you want to take in that. So for us, our framework in which to view risk is maybe slightly different because, as I say, when you're incredibly comfortable with this notion that there is a huge asymmetry of returns in the market, you know, as I say, Scottish Mortgage is one example, but the wider market shows you a similar trend that only that small handful of companies, you know, generate with returns. You know, our focus is on finding that small handful of companies. And so on that basis, you know, the lens in which we view, you know, our risk through is maybe slightly different to a lot of other fund managers. As I say, again, you know, we are not claiming to be, you know, the right fit for everyone. It takes, you know, a certain mentality, a certain time horizon, you know, a certain sort of willingness of that risk appetite. And I think, as I say, we're incredibly comfortable with that. But as I say, when you look at our returns, you know, over that kind of 5 and 10 year basis, you know, that's kind of what we're looking to achieve. We're trying to generate those outsized returns. But we think it's going to be concentrated in a small number of companies.
Well, thank you, Claire. I mean, that was a really fascinating presentation. So thank you for sharing your insights with us. I'm hoping you could please wrap up this pretty lively Q&A session by sharing a key takeaway message for our listeners from today's chat.
Yeah, so as I say, I think maybe just to wrap up, it's again probably first of all a thank you, I think, to all of our shareholders that have sort of persevered through this challenging period that we found ourselves in the moment. As I say, it's not been pleasant. It's not been comfortable. And so first of all is a thank you to our shareholders. I do, however, kind of want to just maybe kind of finish on a slight positive, which is, you know, coming back to what I said earlier, you know, we do think that Scottish Mortgage is a collection of the most exciting growth companies in the world, both public and private. You know, we think that, as I say, the environment that we find ourselves in today, you know, we think those those factors that are going to drive these companies, you know, haven't been massively blown off course by any macro headwinds, you know, we still remain incredibly excited about the opportunity set ahead. You know, as I say, we know there's going to be volatility, we know there's going to be bumps in the road, but I think for us, it's again coming back to that point, you know, for Scottish Mortgage, it's been open to those new possibilities. It's kind of backing that change and the people driving it, and then, you know, for us to sort of invest in them and hopefully, say, play a small role in facilitating, you know, that change for a better society all around. So on that note, I'll maybe say thank you to everyone who's taken the time today to dial in. I do really appreciate it.
Thank you so much, Claire. Now, before we wrap up, let's just take another quick look at the learning objectives for today. Again, they're going to appear on the screen. Excellent. Okay, so that is all we have time for today. Thank you for your questions. Thank you again to Claire for joining me and for letting me and all of you at home grill you with our questions. On that note, if your question didn't get answered, Claire and Baillie Gifford will do their best to do so after the event. And before we close up, just a reminder that your CPD will be delivered tomorrow. And then just before we close off, let me leave you with a little teaser of what's to come from Professional Advisor through the rest of the year. So on the 9th of November, we'll be back with another one of our Working Lunch series, this time with Aberdeen, as we look at the importance of maintaining a well-diversified portfolio, especially in these times of extreme uncertainty. Aberdeen speakers will be their investment specialists, Darren Ripton, Jason Day, and Jim Stacey. In the following 2 weeks, we'll be back on the road again for our At Retirement Roadshow. So that's on the 15th, 16th, 17th, 23rd, and 24th of November. And we'll be visiting Harrogate, Knutsford, Birmingham, Bristol, and London. And you can hear all the latest updates from the likes of Viva Financial Advice, Bordier, Canada Life, Dynamic Planner, Legal & General, LV, and Simply Biz. Then on the 7th of December, our next Working Lunch, which will feature Baillie Gifford, will be releasing details of that session on the website shortly. And finally, on the 14th of December, we'll be wrapping up the year with a Working Lunch with Schroders as they reveal the results of their latest financial advisor survey, which could assist advisors with their 2023 business plan. And for that, we'll be joined by Schroders' Gillian Hepburn and Alex Funk, as well as Philip Martin from Unique Financial Planning. All in all, that is a grand total of 6 hours of CPD for you. So that's it for today's session. All that remains is for me to thank Claire once more for her presentation, for answering all of the questions. Our biggest thanks to you, our readers, for your company this lunchtime. I trust you found this session helpful and worthwhile. And if you did, perhaps we will see you again next month. Thank you very much and goodbye.
Thank you.